Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
It was certainly a dramatic dive today.
I think dramatic is putting it mildly. We went into today expecting a relief rally. The government shutdown resolution was finally signed.
Right.
And yet we saw the exact opposite happen. The market just accelerated into a massive sell-off.
Yeah, it was the worst session since, what, October 10th?
That's right. It was a really bad day.
The indices looked terrible. I mean, the S&P 500 plunged 1.66%, landing at 6,737.49.
And the Nasdaq Composite, which, spoiler alert, bore the absolute brunt of it,
crashed 2.29%.
And the Dow, it dropped 797 points. That erases 2 weeks of gains, and it fell sharply below 48,000. So we have to unpack this strange dynamic. We're calling it the shutdown paradox. Why did resolving all that uncertainty trigger panic instead of relief?
Because the resolution, it just moved the uncertainty. It replaced the political risk with a huge economic policy vacuum.
Okay, so what do you mean by that?
Well, the crisis wasn't the shutdown itself. It was how long it lasted. We learned today that the economic reports delayed by those 43 days.
The really critical stuff, right? Jobs, inflation.
Exactly. The October jobs and inflation data. They've been deemed by officials to be, and this is the quote, permanently impaired.
Wow.
Or lost entirely.
Permanently impaired. That sounds like a technical way of saying the data is just useless for modeling.
That's a good way to put it.
But why is it permanent? I mean, why can't the Bureau of Labor Statistics just publish it late?
It really comes down to statistical modeling and seasonal adjustments. To accurately gauge, say, the October employment trend, you need real-time input to compare against the previous months, against historical trend lines.
Okay.
Well, when those inputs are suddenly missing for a 43-day period, the continuity's broken. The modelers, they lose the foundation they need to make those necessary adjustments. So basically, they lost 2 full months of clean, reliable visibility into the economy.
That is a completely unprecedented information void, especially given where we are in the policy cycle. I mean, if the Federal Reserve is a data-dependent central bank...
They're flying blind.
Right before a massive policy decision.
Precisely. And the market, it immediately priced in that blindness. Earlier this week, investors were comfortable. The market-implied probability of a 25 basis point rate cut at the December FOMC meeting was, sitting above 80%?
It felt like a done deal.
It did. And today...
But what happened today?
Today, that conviction just utterly collapsed. The probability of cut fell to just 52%.
52, that's a coin flip.
It's a total toss-up in a matter of hours. This confirms the fear. The Fed is probably going to default to caution, to just holding steady if they don't have comprehensive data to justify easing.
That throws the December meeting into completely new territory. Okay, so if the market is panicking over the Fed's potential caution, you'd expect a classic flight to safety, right? Stocks sell off hard, people pile into treasuries, yields drop.
You would think so.
But that correlation completely broke down today. Why did the bond market behave so unusually?
This is one of the most important non-equity signals of the day. Treasury yields, they actually rose modestly despite that massive equity sell-off.
They went up?
The 10-year yield climbed 3 basis points to 4.113%. This positive correlation stocks down, yields up. It's telling us something really important.
Which is what?
Market participants are not primarily worried about economic growth slowing down. They're worried about inflation persistence.
So they're saying the economy might slow, but inflation is still sticky and the Fed is blind, so they won't cut aggressively.
Exactly. They're pricing in a prolonged higher rate environment. And that combination, a big equity sell-off plus rising yields, that's just poison for growth in technology stocks.
And tech stocks really took the beating today, didn't they? It accelerated that rotation we'd started to see last week.
Absolutely.
Nvidia was down 3.6%, Tesla crashed 6.6%, and even Palantir fell 6.5%. The whole Philadelphia Semiconductor Index underperformed significantly.
It signals a really critical pivot in sentiment. The market is basically expressing growing skepticism. Can the promise of AI infrastructure spending actually justify these extremely high valuations? especially if the cost of capital stays this high.
And we can actually pinpoint where that risk is concentrated by looking at the index composition, right? The equal weight S&P 500 declined less than the cap-weighted index.
Right.
So for listeners who don't spend their day looking at index mechanics, what does that difference tell us?
That difference proves concentration risk is what's driving the overall losses. The cap-weighted index is just dominated by a handful of mega-cap tech companies, the Magnificent Seven, and their massive valuations pull the whole index down when they sell loss. The equal weight index treats every stock the same, so its smaller drop shows that the typical, mid-sized company wasn't selling off quite as violently as the few giants at the top.
That reinforces this feeling that the market is incredibly narrow. The risk is concentrated in just a few names.
It is terrifyingly narrow, technically speaking. I mean, look at market breadth. Only 41% of S&P 500 components are trading above their 50-day moving averages.
Wow, that's low.
Outside of, acute crisis periods, that's the narrowest reading we've seen since 2003. When that many stocks are deteriorating technically, it shows systemic weakness under the surface.
And that uncertainty is clearly reflected in the fear gauge. The VIX Wall Street's fear barometer jumped 18% today.
Yep. And it pushed the widely tracked Fear and Greed Index squarely into extreme fear territory. The market has officially hit a tipping point of anxiety.
Okay.
Before we move on to credit, though, we should probably touch on Disney. They contributed a lot to the pain in the communication services sector.
Right. Disney fell about 7% on their mixed Q4 results. It was a classic beat on the bottom, miss on the top scenario.
Right. They beat earnings per share, so $1.11 versus $1.05 expected, which is great, but they missed on revenue. $22.46 billion against $22.75 billion expected.
And that revenue shortfall pointed to that continued weakness in linear TV advertising, didn't it?
It did. And that overshadowed all the good news about their parks and the 3.8 million new Disney Plus subscribers.
Okay, let's shift our attention now to the credit market, because this often functions as the plumbing of finance. It tells you when things are about to break.
And it is sounding a very serious alarm right now.
We saw a rapid widening of credit spreads today.
This is maybe the biggest warning signal that equity investors tend to overlook. We're talking about the premium that corporate issuers have to pay over risk-free treasuries, investment-grade corporate spreads. So the cost for stable companies to borrow widened out to 120 basis points.
Give us some context. What was that premium just a few weeks ago?
In late October, that same spread was sitting around 75 to 78 basis points.
Wait, so that's a 60% increase in just 2 weeks?
His velocity is astounding. It's a 60% increase in corporate risk premiums. And high-yield spreads expanded significantly, too, hitting about 461 basis points.
So credit investors, who are generally much more cautious, are demanding 60% more premium just to lend to stable companies? That signals they believe a default or recession risk is rising and fast.
Exactly. This kind of velocity signals that credit investors are aggressively repricing risk ahead of potential equity weakness. They do not like this picture of a blind Fed and sharply deteriorating tech valuations.
And looking for safe harbors in this chaos, gold absolutely stood out today. It gained 0.86% to $4,231.40 an ounce.
Its strength is remarkable, up nearly 65% year over year. It shows persistent demand for safety, even when the U.S. dollar remains relatively strong.
Conversely, we saw a bit of a reality check in energy. WTI crude fell to $58.44 a barrel.
Yeah, that was driven by a crucial revised outlook from OPEC. They suggested global supply would align with demand by 2026, which completely reverses their earlier projection of a perpetual deficit. That takes away a huge structural tailwind for energy stocks.
And a quick final note on crypto, which often acts as a barometer for buy-risk sentiment.
Bitcoin, it managed to consolidate around $103,080. It was down about 1.3%, but it held above that key $100,000 psychological level.
But the sentiment?
Sentiment remains extremely poor across the board. The crypto fear and greed index is sitting deep in extreme fear territory, just like the equity market.
Okay, moving back to equities, let's nail down the immediate line in the sand. What is the critical technical level investors need to be watching now?
The focus is entirely on the S&P 500's 50-day moving average. Right now, it's sitting near 6,660.
And the significance there is historical, right?
Extremely significant. This 50-day moving average has provided rock-solid support for a record 144 consecutive days.
So breaking that long-standing support line would be a major psychological blow. It would probably trigger a lot of automated selling, wouldn't it?
Absolutely. It would signal a significant technical deterioration. It would shift the short-term trend from, bullish consolidation to an outright correction.
So if we pull back and look ahead, we've got technical pressure building, The credit market flashing red, the Fed is flying blind. What are the immediate catalysts that could provide some clarity?
Well, first, the biggest test for the entire market, and frankly, the whole AI investment thesis, is Nvidia earnings next week. After today's tech sell-off, they need to deliver overwhelming proof that AI capital expenditure is justifying these valuations.
And the second thing?
Second, we're parsing every single word from Fed officials. Since the October data is gone, the market needs to know how they'll manage the December decision. Any hint of their internal debate is going to move markets sharply.
This all boils down to a single core tension then. The market has successfully traded one uncertainty, the shutdown, for a far greater one, which is the Fed's policy path without reliable data.
That summarizes the risk perfectly. You need to focus on three concentrated risk factors: the December Fed surprise, with that 52% cut probability, the tech earnings validation, mostly via Nvidia, and the sustained credit spread stress, especially if that 120 basis point widening continues.
Given that an enormous 40.5% of the S&P 500's value is concentrated in just those top 10 stocks, this market is extremely fragile right now. So the provocative question for you to consider is, how much further risk does this concentration create if that critical technical support at 6,660 fails in the days ahead, forcing a real test of that narrow market breadth?
That's a powerful thought to leave things on.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.